The Federal Reserve kicking off its two-day meeting tomorrow and is widely expected to keep rates steady. Joining us right now to talk about the path to rate cuts, Roger Ferguson is the former Federal Reserve Vice Chairman, former TIAA President and CEO, and a CNBC contributor as well. He's got a lot of things on his resume. Roger, it's great to see you. Do you have a new view?
Nice to see you, Andrew.
You got a new view, given all the numbers that we've seen thus far? Is this pushing things out? How quickly is Jay Powell really going to be lowering interest rates in your world?
In my world, it's still the second half of the year. And for me, that's not a new view. I think what we've seen is an economy that is still strong. The last GDP print, I think, surprised a little bit. The good news is the last PCE print suggested that the disinflation process is underway. But there are some concerns that a few people might have. Some of the turmoil in the Mideast might lead to pick up slightly in goods inflation. And the service sector still is a little hot. So I think second half of the year still is my bet at this stage. And I think the market is starting to come at least in that direction.
And is that a 3-cut situation, a 2-cut situation, a 1-cut situation? What are you thinking?
I'm thinking may well be 3. The issue obviously is, fortunately, inflation looks like it is moving in the right direction. They have no need to stay in restrictive territory in the real rate, the nominal rate minus inflation. And so, I think squeezing 3 in the second part of the year is still my base case. Certainly not more than that, possibly a little less if things slow down. So that's where my head is right now, and that's not a dramatic change for me.
Okay, you can answer this question with more authority than practically anybody we've had on the broadcast recently. So I want you to end this debate for us, if you could, or maybe we'll just continue it. You know where I'm going with this? So we have a lot of people who come on who say,
I'll let you go.
Who say, you know what? It's very difficult for the Fed to start lowering interest rates in a presidential election year as you get closer to the election itself. And that weighs on everybody. It actually is part of the conversation. And therefore, they may not do these things, or they're going to want to do these things before that. Take us, you had the job. Take us inside the room. Does the presidential election become part of the actual discussion itself?
I've never been in the room when the presidential election was part of the discussion itself. I can't speak to what's in everyone's mind, obviously. But think about it. If they cut early and it proves to be the wrong thing to do, they'll find themselves raising rates in an election. If they delay, they find themselves losing the possibility of getting, the soft landing that looks like it's within grasp. At the end of the day, following the economics is the only thing that matters, because that's how you get to the best outcome. And if the politics get in the way of that, then someone's going to look bad. And so I think the logic of the case has got to be follow the economics, carry out your plan, because that's the only way to actually stay out of harm's way.
Hey, Roger, Nick Timiraos at the Wall Street Journal had an article that hit yesterday that raised a lot of questions about what we might anticipate the language change could potentially be coming out of this meeting this week. That while he doesn't think they're going to be cutting rates this week because the economy's been pretty steadily growing, it does raise this question about whether they're going to ditch the whole idea about the most likely scenario being that rates would rise from here. You think that is a reasonable way of looking at things, kind of easing your way out of that to open up the door for potential interest rate cuts?
I think they're going to have to acknowledge that inflation is coming down closer and closer to the 2% target. Consequently, that gives them some room to move rates lower. So they're, I think, going to try to guide as softly as they can towards the second half of the year cutting. They certainly want to keep in place at least, the 50-50 in March and try not to, raise expectations of an earlier cut. So it's going to be walking a bit of a fine line by admitting that, yes,
yeah, I was going to say it's hard to not raise expectations of the March really happening without signaling when you're signaling something like this.
I think that's right. So recognize what they're going to. I think they're going to try to hint at a delay, but I think in the conversation, Chair Powell is going to talk about the SEP and other things that seem to put that delay, that cut towards the second half of the year. But it's going to be a tightrope for him.